Robert, let's start with housing today. In your report out, you say housing-related metrics for July were clearly weak. Can you expand on that?
Existing home sales for July fell about 1.7%, the fourth consecutive monthly decline. It's not sliding precipitously, but it's obviously not growing, and it's sort of stable or moving sideways, stable to sideways, near its long-term average. New home sales tells us a little bit about the accelerating part of the housing market for the overall economy, because new home sales are obviously related to new home construction. That has also been a little weak, falling for the second month in a row. So overall, we have to say the housing markets are not feeling some of the glow from the strong second quarter numbers, GDP numbers that we've seen, and are definitely not leading the economy forward, but maybe trailing at this point, and in fact, probably sliding a little bit backward.
Robert, moving on to consumer spending, we have a strong labor market, high consumer confidence, and the benefits of tax reform. But you say there are still some vulnerabilities, and what are those?
Yes, Susan, consumer conditions are generally very good for all the reasons that you've been talking about here. But I think there's some areas that we should at least keep our eyes on. One is housing, which you've already mentioned. A lot of consumer spending is wrapped around houses. Think of all the things you need to buy when you get a newer existing home. And likewise, auto sales probably past the peak and on a plateau, maybe a negative slope on that plateau, gradually tailing down. So two big areas that are related to consumer spending look vulnerable at this point, despite all the positives we're seeing from strong labor market and other good conditions.
Robert, let's move on to what's happening with the Fed. We had the FOMC meeting, the notes were released, and then also the annual Jackson Hole meeting. So what have we learned from that?
Yes, Susan, we got a lot of verbiage from the Fed this week. One was the set of minutes from the most recent FOMC meeting over the end of July, early August. And then we also saw an important speech by Fed Chair Jay Powell in which he outlined some of his thinking about how to set monetary policy going forward. And it all boils down to this key word, gradualism. And we've seen that this year with steady Fed funds rate hikes over the about an every other meeting pace through the year. We're expecting one more here in the third week of September. We're expecting the last one in December. That would be 4 rate hikes. But I think the Fed's focus on gradualism is going to have to shift next year. I think the Fed's going to look to amend that a little bit. I'm not expecting 4 more rate hikes in 2019. I think 4 sounds too much, 1 maybe not enough, so 2 to 3, maybe my bet would be on 2 at this point going forward. So we're looking at a little shift here in the Fed policy as we go into 2019 and we start to anticipate an economy that feels a little bit slower, especially toward the end of next year.